Hey there, real estate enthusiasts. Welcome back to our channel. If you're new here, I'm your name, and today we're diving into an essential concept that every real estate investor should understand: due diligence. Whether you're a seasoned investor or just starting out, grasping the importance of due diligence can mean the difference between a profitable investment and a costly mistake. So, let's get started. Let me ask you this: how do you make sure that the property you're about to invest in is not just a pretty facade, but a solid investment opportunity? This is where due diligence comes into play. But what exactly is due diligence, and why is it crucial in real estate investing? Due diligence is essentially the process of investigating and verifying all relevant aspects of a property before making a purchase. It's about doing your homework to ensure that you're making an informed decision. This process typically involves a deep dive into various areas, including legal, financial, and physical due diligence. Let's break these down one by one. First up, we have legal due diligence. This covers all the legal aspects of the property. You'll want to check the title of the property to ensure there are no liens or encumbrances. A lien is a legal right or interest that a lender has in the property, granted until the obligation is satisfied. For example, imagine you find a fantastic property at a great price, only to discover later that the previous owner had unpaid taxes, resulting in a lien. This could lead to you inheriting that debt, which can be a financial nightmare. Also, ensure that the property is zoned for its intended use. If you're planning to convert a single-family home into a rental property, but the zoning doesn't allow it, you're in for a big surprise. Always verify zoning regulations with your local government. Next, we have financial due diligence. This step is about assessing the financial health of the investment. Key documents to review include the current lease agreements, operating expenses, and any historical financial statements. For instance, let's say you're looking at a multifamily property. You'll want to analyze the rent rolls to ensure that the income is consistent and that tenants are paying on time. If there's a high turnover rate or significant unpaid rents, this could indicate deeper issues with the property or management. Also, don't forget to factor in potential future expenses, such as property taxes, maintenance costs, and potential renovations. A good rule of thumb is to set aside about 1% of the property value annually for maintenance. This can help you avoid unexpected costs down the line. Finally, physical due diligence involves inspecting the property itself. This means hiring a qualified home inspector or contractor to evaluate the condition of the building. For example, if you're considering buying an older property, you'll want to have a thorough inspection of the roof, plumbing, electrical systems, and foundation. A small crack in the wall might seem insignificant, but it could indicate structural issues that could cost thousands to repair. Additionally, assess the surrounding area. Look into the neighborhood's crime rates, school districts, and future development plans. A great property in a declining neighborhood can lose value quickly. Lastly, a crucial part of due diligence is conducting a market analysis. Understanding the local real estate market will give you insights into property values, rental rates, and demand. Tools like Zillow, Redfin, and even local real estate agents can provide valuable information about comparable properties. For instance, if you find a property listed at $300,000, but similar homes in that neighborhood are selling for $250,000, it might be a red flag. Always check the market trends before making an offer. Now, let's look at an example to tie all this together. Imagine you're eyeing a triplex in a suburban area. You conduct your due diligence. Legal, you find out there's a minor zoning issue, but it can be resolved with a simple application to the city. Financial, you discover the current rents are below market value, meaning you can increase them after a year, boosting your cash flow. Physical, the inspection reveals the roof needs replacement, but you negotiate a lower price that accounts for this repair. Market analysis, you learn that the neighborhood is up and coming, with new businesses opening and a growing population. By completing your due diligence, you set yourself up for a successful investment rather than a financial pitfall. In summary, due diligence is an indispensable part of the real estate investing process. It involves legal, financial, and physical assessments, as well as market analysis to ensure you're making a well-informed investment. Remember, taking the time to do your due diligence can save you from costly mistakes and lead you to successful investments. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more insights into real estate investing. And if you have any questions about due diligence or other real estate topics, drop them in the comments below. Thanks for watching, and happy investing!